Most retirees don't lose money because of the market. They lose it because of what they do when the market drops. It's a pattern I've seen over and over again, even with smart, wealthy, well-prepared retirees. And after working with hundreds of retirees, I've noticed the same handful of decisions being made again and again, especially during downturns. And the worst part is they don't even realize they're doing it. There's one chart I show clients that makes everything click. It's simple, but it explains why two people can retire with the same investments and end up in completely different places. So stay with me, I'll show it to you in just a minute. Have you ever felt like you needed to do something when the market started dropping? Maybe sell a few investments, move to cash, or simply wait it out? You're not alone, and that exact instinct is what we need to talk about today. And again, later in this video, I'll show you the chart that helped one of my clients stop checking their portfolio every single day because he realized he didn't need to panic when the market dropped. He had a plan. And once he saw how that plan protected him, he finally started sleeping better at night. But here's the big myth that trips up a lot of retirees. They think the market is the enemy, that if they just avoid the next crash, their retirement will be safe. But here's the truth. The market's job is to go up and down. That's normal. What's not normal is how we react. That's where things go sideways. It's not the dips that destroy retirement, it's the decisions people make during the dip. They panic, they sell low, or they sit on the sidelines and then they miss the recovery. From 1980 to today, the S&P 500 has dropped an average of 14.1% at some point every single year. So take a look at this chart. Every single red dot shows how far the market dropped at some point during the year. So some of these were pretty big declines, and yet it still ends the year positive around 75% of the time. In 2020, the market dropped 34% in just weeks, but it still finished the year up 16%. Now, perhaps you'd like to think that's an exception, but I'd argue that's the pattern. And that's the game. It tests you, and then it rewards those who stay calm. The mistake is thinking the drops mean the year is ruined, but it's not about predicting the dip. It's about having the discipline to hold through it. And that's because the market isn't out to get you, but your emotions in the midst of a decline, they might just be. And if you don't have a system in place, a way to stick to your plan when it feels like everything's falling apart, then even a great portfolio won't be enough. Now here's when things get even more dangerous, and it's something most retirees have never even heard of. It's not just about how much the market drops, it's when it drops that can do the most damage. And here it is, the chart that explains why retirees run out of money in retirement. I want you to imagine two people retiring with the exact same portfolio, same investments, same withdrawals, but one retires right before a crash and the other retires just after. Now, over time, the differences can be hundreds of thousands, even millions of dollars. So take a look at this. All three of these portfolios start with the same amount of money. All three earn the same average annual return over time of 7% per year. But look at the results. One ends with over 1 million, one drops to 400,000, and the last one runs completely out of money. This is called sequence of return risk, and it's the silent killer of retirement plans. It doesn't just lower your balance temporarily, it increases the odds that you'll run out of money. And the worst part is you don't feel it until years later when it's too late to adjust. And this, my friends, is what wakes retirees up at 2 a.m. The fear that one early market drop could derail everything. But once I walk clients through this chart, everything shifts. They realize they don't have to fear the drop, they just need a plan for it. And one of the most effective strategies we found to combat sequence of return risk is using a war chest income bucket strategy. It gives people permission to stop stressing over the market because their income is already protected. We separate money into 3 buckets. Now, which is what you need in the short term, soon, which are stable assets for income in the next few years, and later, which is long-term growth that can ride out volatility. This way, you don't have to sell your long-term investments during a crash because you already have your short-term income covered. That's how you make volatility survivable, and in some cases, even irrelevant. Now, the sequence may be out of your control, but your strategy is entirely up to you. Now, here's something I hear from financially savvy retirees, the kind of folks who read all the white papers and love a good Sharpe ratio. I just want a portfolio with a better risk-adjusted return because that'll reduce my sequence of return risk. And that's not wrong, but here's the problem. You can't eat risk-adjusted returns. And here's what I mean by that. You can have a perfectly optimized portfolio with low volatility and uncorrelated assets, but if you're not earning enough real growth to fund your life, it's not doing the job. Most retirees don't care about fancy portfolio metrics. They care about whether they can fund their lifestyle, take the trip, help the grandkids, or cover rising healthcare costs. What you really need is a portfolio that you can hold through volatility and one that's designed to deliver the dollars you need over 30 plus years. And to hold on through the volatility, we found the war chest income bucket to be one of the best ways to provide just that. I'm not saying risk-adjusted returns aren't important, but in retirement, real dollars and real outcomes are what truly matter. And to get those, you have to stay invested long enough to benefit from them. But let me show you how you can actually use downturns to your advantage. Let's talk about what most people miss during a market crash. Yes, it's scary. Yes, your balance might go down, but a downturn is also one of the most powerful planning windows for retirees, but only if you know how to use it right. And that's because most people pull back. They go to cash, they freeze. But what if I told you that a downturn opens up 3 key opportunities for retirees? So let's say your IRA was worth $100,000 before the crash and now it's dropped to $70,000. If you convert it to a Roth IRA at the lower value and it rebounds, then all that recovery is now tax-free. You pay tax on the smaller number and your future self gets more tax-free income later. Now here's another strategy. Let's say you have a non-retirement account you're invested in. You sell an investment that's temporarily down in value, lock in that loss for tax purposes, and then immediately buy something similar so your money stays invested and you take advantage of the rebound when it comes. Again, that loss is locked in for tax purposes, which can now offset other realized gains you may have, and in some cases can reduce your taxable income, keeping more income in your pocket, and you never missed out on the growth. And finally, there's rebalancing. In 2020, during the sharp COVID crash, stocks fell fast while bonds held steady, and we used that opportunity to sell some of what held up well and use that money to buy what dropped in value. That's not panicking, that's discipline. Because often the best time to rebalance will only seem like a no-brainer in hindsight. If you sell some of your winners to buy other stocks that are down, in the moment, it'll feel like a horrible decision. And if you use some conservative investments to buy more growth-oriented investments, it won't feel like the right time either, because typically the market begins rebounding when things seem and look the worst. This is why crashes don't just test your plan, they test your mindset. Most people react, but smart retirees strategize in advance. They convert, they harvest losses, and they rebalance. In other words, they use the crash instead of fearing it. And once you realize it's something you can use to your advantage, you stop seeing red arrows down as a threat and you start seeing them as an opportunity, and that's when everything starts to change. So again, I want you to remember that chart. Same return, 3 very different outcomes. That visual doesn't just explain why retirees lose money, it reveals what happens when you don't have a strategy in place. And for many of my clients, seeing that risk is the moment they realize, you know what? You don't need to fear the next downturn. You just need a plan that's built to handle it, because once you understand the pattern, you stop reacting, you start planning, and you stop fearing the volatility, and you start using it to your advantage. If you found this video helpful, I want you to check out this next video, which is Warren Buffett's bizarre warning for retirees and why it matters more now than ever. We'll see you over in that video right now.